It is a pleasure to be joined once again by Warren Pies, co-founder strategist of 3Fourteen Research. He's going to help us make sense of the equity and commodity markets, all things together. Warren, thank you so much for joining us.
Yeah, thanks for having me.
Yeah, always a pleasure. Scott, you want to kick it off? Actually, wait. You know what, Warren?
You got to tee up Warren. What is Warren all about? I want to hear.
Exactly. And what is 3Fourteen? Tell us the process, the idea, the concept. Sorry, yeah, that's the key precursor here.
Yeah, for sure. Yeah, 3Fourteen Research. That's my company. I'm a co-founder along with a few other partners. We are a macro quantitative research shop, and so everything's data driven. We're independent, objective, and we look at the world with a top-down perspective. We go everywhere in the macro landscape, and I think we've kind of proven that through our research and interview cycle, and hopefully this conversation too. But my background is originated in the commodity markets and specifically oil and energy. So I have a strong base there, and I think that does help, especially in this cycle, to understand the macro picture.
Now, speaking of energy, let's start off because you made some calls in the summer that you thought energy could have a rally here into the fall. This is exactly what we got. But what I wanted to ask you, so that was a great call. Deserve all the kudos there.
Incredible
Now
call.
I'm curious, now that we're at a point where oil is $20 higher than it was in the summer, what are some of the metrics you're looking for that show you maybe there could be a pullback? Are we headed to triple digits nonstop here? Like, what are you looking at and what are you thinking at this point?
I think that the majority of the move is over at this point for now. Our call was that we would hit $100 oil before this year's over. Our benchmark is Brent, and so we've gotten very close. We were about 97, just under 97 at the peak on dated Brent, and that's what we go by. So I think I'd stand by that $100 projection. I think we will see 100 before this year is over. I don't believe that we shoot way above that though, and I think that the things I'm watching and the reason I feel that way. Number one is positioning. And so you got to understand why the rally is getting close to you, and you have to kind of understand what started the rally. And when we started this rally, what we had were hedge funds and CTAs, the managed money group within the CFTC data, as short as they have been post-COVID within the oil market. And so you had a huge short position, and that had really been hanging out and growing throughout the year. And the way I reconciled that is I saw these hedge funds and CTAs, they were really making a macro bet. They expected to see a recession this year, and so they were expressing that view with a short oil position. You saw this across assets. So that was the setup. And on the other hand, you had the Saudis and OPEC who had basically seen this, and in their view, the market was not as sloppy as this view and the recession view justified. So they wanted to run these shorts out of the market. And so that's when you started seeing OPEC announce cuts and then actually cut, and then Saudi Arabia doing an additional unilateral cut. And that has been the real proximate cause of this rally, is that the Saudis have really almost on their own pushed this market into a serious deficit, forced these shorts to cover. And now as we sit here late on the doorstep of Q4, late September, that same managed money group has covered their short positions and are now overextended long, and that they're as long as they have been. By the way, we measure it, crude oil, as going all the way back to 2019 and 18. And so to me, you really don't get a lot of fuel from that group of within the futures market. And there's some other seasonal reasons too that I think oil is probably going to at least consolidate here.
That was a great graph that you tweeted out a few days ago, just looking at how low that spec interest is in it. Just maybe on to your point is what's been interesting is as you're calling it top here too, it feels like the equities, the underlying oil equities, just aren't really moving further high. They've decoupled themselves as a almost a confirmation. Maybe your thoughts on that, if you view that as a confirmation to your take.
Well, you always think of these kind of commodity-based equities as kind of half commodity beta, half stock beta. And so you've had a weak equity market backdrop. So that's kind of just last year was such a crazy year to see energy up so much and the rest of the market in the toilet. Usually it doesn't happen like that. It's not, you don't usually get that negative of a correlation. That was something else. And so you have the overall stock market. You also have the fact that the futures curve, if you do some sensitivity analysis for energy equities and oil, they trade more off of the 1-year strip versus spot oil prices. And just the fact that we're in this really steep backwardation where spot and near futures are much higher than 1 year out, which is all those contracts are included in the strip. That means that the realized value, the ability for them to lock in realized profits is lower. And the other part that it hasn't factored quite as much, but I think it is somewhat of a factor, is that this equity market, this energy sector, is so dominated more than it ever has been by downstream. And this is a point I've been making for my clients. And downstream those are margin players. They're not pure higher energy and natural oil and natural gas exposure. Those are the most economically sensitive stocks in the market, in my opinion. And so that's another factor. They kind of move. So you wouldn't expect them to just move with the price of oil unilaterally. It's a more complicated analysis there. So those are kind of the factors I'd say. We've done a lot of work on this lead lag, and our conclusion is exactly what you're saying, is that the equities actually do generally lead the oil price. And we saw this actually earlier in the year too. If you remember, oil went down a lot more than the energy stocks did. Yeah. And everyone was like, what does this mean? And we had done a lot of work at that point in time. And the conclusion was oil's going to come back up to meet these energy stocks. And so part of that's in here too. You've seen, if you take that chart back a little bit farther, energy has really outperformed oil over this entire year, at this point in time.
It's an incredible conclusion that just that aspect that the stocks themselves are predictors of the oil price, and that kind of that's a profound that's profound, right? And it doesn't really kind of, because we're so focused on watching all the players, meanwhile the equities themselves are saying I'm going to discount this all.
Actually, absolutely, yeah. I think it's not always that way, but it's at these extreme divergence points. That's the lesson of history, is that the energy stocks are more right than the price of oil.
And Scott, maybe just one other question just on the OPEC side. So given that, surely Saudi wants to manage this here. They don't want to see this run over 100 in a meaningful way here. Maybe your just thoughts on what their calculus is going forward.
Yeah, I think their calculus was, number one, we want to teach. ABS said this himself. We're going to teach these. We're going to make the shorts ouch or something like that. I can't remember what the exact quote was, but he's done that. He wanted to teach these shorts a lesson. So mission accomplished. He's reset positioning within the market. They are now, say Brent's at 95 a barrel or so right now. Their budget breaks even here. So their budget breaks even somewhere between $85 and $90 a barrel. And so checked that off the box too. And now you do have to start wondering about how high would they push the price of oil beyond this point? Because you're starting to get, now it is on CNBC. It's gone from the back page of the newspaper to the front page of the newspaper, and it's becoming a concern for DC. So I think the sweet spot for OPEC is to manage this market and to cap the price of oil. So I've been writing also to clients saying, I think this, like we said, proximate cause of this rally, it started with supply reductions out of OPEC. I think it ends with some supply coming back online from OPEC as well. And that could be, it could take many different forms. It's hard to say exactly how that oil comes back. It could be a little bit of job owning. It could be cheating while they still talk tough. You have to watch all these things, but that's what I believe is going to happen. I think you end up seeing that OPEC starting to take their foot off the gas a little bit here.
Now, Warren, you've done a lot of good historical work on energy leadership is historically not great for the future direction of stocks. Could you just explain a little bit more to everyone listening, why you think that's the case historically?
Yeah, I mean, if you think about the message that's sending, it's usually that you're, number one, we've done a lot of work on, it's a late cycle phenomenon usually. And that's kind of our working thesis, that we are late cycle right now in the U.S. economy. And so by definition, if you're late cycle, the next thing that happens is a landing, whether it's a hard landing or a soft landing. And you can break it down even further and see that energy outperforms going into hard landings, going into recessions, and it underperforms going into soft landings. And so we've looked at, say, if you just broadly define a soft landing, we've had 4 of them, and energy underperforms coming through soft landings and outperforms going into recessions. So you think about it, it's because at the end of an economic cycle, right before a recession, you often end up with a spike in the price of oil. The economy is still growing. I always talk about oil as the shortest duration asset on the menu. And what I mean by that is, unlike a stock that can look through to the next 12 months and discount that recession that's coming, oil it's nearsighted. It only sees right what's in front of its face, and it can only move off of that. And so even if a recession is 6 or 12 months down the road, oil is trading off the supply and demand right here and now. And so it can't discount. It doesn't discount a future at like a normal financial asset does. And so that's a big, I think, nuance on why oil can outperform in the late cycle environment, while other indicators, leading indicators, are kind of rolling over. And it's a classic, what I'd say is a mixed signal as you get to the end of a cycle that a lot of investors have a hard time interpreting.
Now, you mentioned a little bit on hard landing versus soft landing. Now, you're a student of history. I'm just wondering, what is history telling you about the chances we get a soft landing here, and kind of what assets would you own right now if we're headed for, say, a hard landing versus a soft landing? Because I know what's priced in right now, you're basically saying is kind of soft landing is priced in at the moment.
Yeah, I think that number one, soft landings are rare. You can find at most 4 of them going back historically, and some of them are kind of debatable on whether that's a real soft landing. But let's just say there are 4 times we've had a soft landing. We've had, double that number of hard landings. And so, if you count each cycle, it's at least 2x more likely that you end up in a recession versus soft landing. So that's your base case starting point. When you start considering the backdrop right now, there are a number of other factors that have me leaning towards a hard landing. Number one, we've never seen a soft landing come out of an inverted yield curve. So that's a pretty big and easy and stark thing to understand. We've never seen that. Obviously, we've had the most inverted yield curve that we've seen for the last 40 years. So this is not just somewhat inverted. This has been an extreme inversion here. And so that's one factor. And then the other big factor that we found is a soft landing requires what we call a hyper-reactive Fed. And so the Fed is, if you look at these soft landing cases, the longest pause that the Fed's ever had in a soft landing was 7 months. And usually what you get is the Fed turns around and cuts rates like 2 to 3 months after they hit peak rates for that cycle. And now you go back and think about the rhetoric that the Fed has. We think the Fed's on pause now at this point in time, but I do not believe there's going to be a cut anytime soon from the Fed. And so when you mix this higher for longer environment that we're in right now with the history of the need for a hyper-reactive Fed, it's difficult to see a soft landing occurring. Now, the other factor on that is the Fed is basically telling the market in the coming out of the last FOMC meeting that it's not going to be hyper-reactive. So you've got these bulls in the stock market, and we're going to talk about that in a minute, but the bulls in the stock market are saying, we think there's going to be a soft landing. We think the Fed is actually going to cut because inflation's coming down and the Fed's going to cut. We have lagging housing inflation data and all these other things, and if we swap this and that and do all these gyrations, then in fact, inflation's a lot lower than it already is. That it's already stated, and the Fed knows this, and Powell knows this, and they're going to cut rates. We get to 3% on the CPI. They're going to cut rates because they don't want to. And so that's the bull soft landing thesis as I see it. Now, what did the Fed say? They came out with their SEP, their Summary of Economic Projections, and they can signal through that what they see happening over the next year. And one of the things they signaled in that is that we're going to have higher real rates next year, that inflation's going to fall, but the actual the Fed funds rate is not. They pushed the cuts out.
So they're not planning to cut. That's what that is indicating.
Exactly. And when they say inflation's going to fall, and we're still not going to cut. So what they're saying is we're not going to be hyper reactive. They're saying exactly the opposite of what we just said is necessary in a soft landing scenario. So that's why I think you've seen the market react so negatively coming out of the last FOMC meeting. The point that, what do I like now, given this backdrop? What do I like? Well, when you look at the stock market, which is your broad S&P exposure, I believe the stock market is priced for a soft landing. The 2024 earnings growth is about 12%. And then 2025 earnings growth, another double-digit year of earnings growth. So this is a straight line of earnings. You don't see this in a hard landing environment. You see this in a soft landing environment. So that's your S&P 500 picture. So if most people, that's the core of your portfolio, your index, S&P 500 equity exposure. And of course, you want to stay somewhat invested. That's just what you have to do. But you need to diversify. And every cycle calls for a different diversifier. And it's up to us to figure out what actually diversifies. And we're finding that bonds don't really diversify in this cycle. So what diversifies? If the market is pricing in a soft landing, then assets that outperform in a hard landing are actual diversifiers. And the ones that outperform that I've found, energy equities, gold, as we talked about before the call, are both outperformers in a hard landing environment. So I think you want to overweight those assets relative or to your history and add those to your equity exposure, because equities want soft landing, so we need to diversify by finding hard landing assets. And one day maybe bonds will be there too, but we're not there yet.
Got it. Okay. So I'm just thinking energy in particular, when you get a hard landing, you know, you have a drawdown in stocks, everyone's worried. They go down in the short term, but over, like, say, a 12-month period or something like that, that's where they outperform in a hard landing scenario. They'll bounce back much faster, so that overall they're outperforming stocks, for example.
They outperform particularly into the recession. So you got to remember the
we're seeing now.
Yeah, so the NBER, when it comes in and paints that little line on the chart and says this is where the recession began, it takes them 6 to 12 months to look back in the rearview mirror and do that. In the meantime, we all are in a recession. We all know it. And energy is, taking over and leading the market. And in fact, you're in the middle of a recession. So if you think back to 07, 08, it was NBER. We were in a recession at the end of 2007. And NBER didn't declare a recession until the beginning of 2009. And so all that period there between that, leading right up to the recession and through the first stages of that recession in 2008, beginning of 2008, you saw oil and energy equities outperforming, and gold.
Yeah, it feels a little similar right now, having lived through it.
And Warren, I know we talked about this before the call, but just with respect to gold and how it'll act this time, and especially as the correlation with bonds. I saw an interesting chart that just, historically, if you kind of look over 100 plus years, this idea that bonds are negatively correlated, that's kind of a more recent phenomenon. Like, maybe you could just comment on, and does that offer the opportunity for gold to really step in as a diversifier, as bonds don't really do the job that we're in recent memory that we're used to?
Yeah, absolutely. I think it's going to be a group effort. And I think gold's one of those stocks or one of those assets that's going to help diversify in this environment. And so, yeah, the whole 60-40 thing, and now everything I'm saying right now, this is what happened earlier in the year. We pointed this out to clients and anyone who would listen. 60-40 ripped coming out the chutes this year. Stocks rallied and bonds rallied, and then everybody came out and said, oh, this idea that 60-40 is dead is so stupid. Look what's happening. And then what they're missing is that 60-40 is just going to be way more volatile. And that's what's killing 60-40. It's not a good thing to see this positive correlation between stocks and bonds. It actually hurts 60-40 returns and really hurts volatility adjusted returns on 60-40 over the long term. So you're actually celebrating something that you shouldn't be in that case. The day you celebrate as a 60-40 cheerleader is when the stock market gets crushed and bonds get a bid. And we're not seeing that today. We're getting a big down day in the markets, and it's actually yields forcing the market down. And earlier this year it was yields helping the market higher. That's not a healthy environment for 60-40. So yeah, gold's going to be something you could look at. I think an overweight to energy and commodities in general is another asset. And we look at managed futures. I think managed futures is going to be another asset that's emerging that helps diversify. But the bottom line is none of that stuff is going to give you that golden era of 60-40. And the golden era of 60-40 was like 1998 to 2020 when COVID hit. And COVID, I think, is going to bookmark it. We had the Asian financial crisis mark the beginning, and I think COVID's going to mark the end of the golden years for 60-40.
Well, Warren, that's a powerful statement. You wrote that down. This idea that it's the vol of 60-40 that will break 60-40. And if you kind of just take that back a step, right? Who's like selling 60-40? Well, you think about what this era has ushered. Well, it's a whole lot of advisors. There are great advisors, but then there's a whole almost like just robo-esque advisors who just like sell 60-40. Let me just handle your life because this formula is great, and don't you worry about anything. And I'm gonna put you in index stuff, low cost stuff, 60-40. Like it just feels like we're in a unique point where if you're thinking, it'll put back in focus active management. Maybe your thoughts on that. I don't know if if you have a view on just how active can really step in here, because it just feels like we've bought into this incredible mantra of like set, forget, low index, 60-40, and let me just help your other stuff and charge my 1% as an advisor. Like hopefully my thinking is that's got to change.
For sure. I mean, like I think that the old rule of thumb is like, okay, you're 45. Well, that means you have 45% of your portfolio in bonds and the rest is in stocks. And now I'm going to go hit the golf course. And, those days I do think those days are over. I think it's good for people like us that think deeply about these things. And it's going to be a rude awakening for a lot of other people. We, at 3Fourteen, when we started the company, this was kind of the big change we saw. I mean, our first reports, we said, we speculate that COVID is going to end the era of the 60-40 negative stock bond correlation. And then we go through and show, just adjust the correlation between stocks and bonds and see what that does to a 60-40 portfolio, and it basically destroys it. And so then the thing we did is come up with a solution. So you don't want to identify a problem without a solution. And our solution is we have a big asset allocation model. We call it a real asset allocation model, and it's 20 assets. And it's basically taking that 60-40 portfolio and pulling out pieces of your equities and pulling out pieces of your bond exposure and putting in a lot more alternatives like we discussed, whether it's commodities or energy or metals and miners and managed futures and gold. All those things, real estate, all those things are in our overall model. And it's a trend following model because at this end of the day, just like we talked about, you don't know which one's going to be a good diversifier. You can study history, and there's like regimes where commodities diversified and there were regimes where it didn't. There were regimes where gold did well and diversified, and there's regimes where it didn't. You need to have some kind of trigger, some trend following type of trigger that tells you that that this is what's helping you right now. Instead of the set it and forget it, low turnover world is kind of behind us. And I think it's a tough pill to swallow, but that's the other side. You have to accept a little more turnover to hit your return goals, I think, in this world.
Super exciting, and like that, nothing could be more exciting than active coming back into the fold. Like, in this view that you actually, you go out there and pick assets that win. Now, one question and just a bigger picture is just in your asset allocation model, how you think about real estate and historically it being a protector against inflation. Just given where we sit right now, maybe your thoughts on how an investor should think about real estate in their portfolio.
I mean, I think there's a place for it, and you just have to be smart about it. And there's also real estate is like we play it through a REIT, like a REIT exposure. That's how our model works. And I like the liquidity and the mark to market of REITs. If you're going through private real estate right now, you don't have the liquidity or the marks that I think you would want in this kind of environment. And so that's an important distinction is public real estate, it's a more honest game than private real estate at this point in time. And there's, obviously private real estate's done really well for a long time, but we've had some seismic changes over the last few years. So you better know what you own or know what your managers own if you're going to be in those spaces. So that would be kind of my general feeling there. But I do think also another general thought is you don't want to shy away from real estate entirely because it is a real asset. At the end of it, we added $8-9 trillion in treasury debt over just the last few years. That's basically a 50% increase over total outstanding debt before this pandemic. And so that's kind of just like a big fiscal response that's going to go out. So we have an asset shortage. And so there is going to be in every one of these assets, housing and stocks, I think this just level step up from what happened when all this stuff shakes out. And so you don't want to be unfortunate for a lot of people in society. If you don't own stuff, this is an awful time to be living through, honestly. I really do genuinely feel bad for people like that.
Warren, what kind of I struggle with telling people, to your exact point, is this idea where people are like, well, I'm just going to wait for real estate to get super, super cheap again and life will, you know what I mean? I'm a 20-something, 30-something, like, woe is me, life's been bad, but I'm going to get you boomer, you millennial, you got a chance to load up. But what if that doesn't come? Like, you got to make the best of Buffalo kind of thing. You know what I mean? You got to make the best of a tier 2 city. And I don't think people are like waiting in line for Toronto and New York City. I'm like, fuck, even you missed that, man. It's okay. Like,
get your delicious cappuccino and call it a day,
Well, I mean, let's not be crazy. Buffalo is like, let's not be crazy. I've been to Buffalo one time. I was in Buffalo one time in June, and there was still snow on the ground. I don't know, man.
Yeah.
You might overstate it.
June snows are not good for anyone's mental health.
So, I don't know, but that's easy for me to say being in Florida. I think that it is absolutely a tough environment. And I do think that if you're waiting for a massive crash, maybe in some sub-segments of the market, like office and things like that, but the housing market is underbuilt. And you have a huge portion of millennials who are entering into, in the next really 12, 24 months, starting to enter into that 35 to 44-year-old age group. I mean, that's my age group. And that's where even the classic delayed millennial, everyone's going to want to start having their own little slice of suburban heaven here in the next few years. So I don't see a big crash in the price of housing, once housing starts weakening, the economy is going to weaken, and this is one of our big calls. And once the economy starts weakening, the Fed will cut rates, and rates will come down, mortgages will normalize. And so I don't see a real estate crash, a housing crash, let's say. I think you'll see a correction in a rough period, and we're in there right now, but not a crash because the underlying fundamental dynamics don't justify it.
Our economist is on board with you. He thinks if it comes down to the job market or fighting inflation, the Fed will cave and just say, got to hold the job market up, time to cut.
To a certain extent, I think that's right. But, that's where things like we go back, the whole conversation gets back to the beginning, that's why you want to be involved in energy and oil, because there are things that can tie the Fed's hands. And if we had a spike in the price of energy, then the Fed's hands are more tied, and so that's the other reason why also however long the cycle goes before a recession is also, I'd say, just a net bullish thing, because the longer the runway, then the Fed can be more reactive down the road. If you go back to like 1 year ago when everyone was calling for a recession back then and inflation was like at 9% or something like that, if we had hit a recession at that point, I don't think the Fed could have done anything. Even in a recession, at least they have some scope to act now, and as time goes on, they'll have more scope to act in a recession. So, yeah, and in that case, they wouldn't have to balance so much between jobs and inflation.
Warren, before we get off the soft landing talk, I wanted to ask a question about your findings. Did you see in those soft landing scenarios, was there ever a time where we got a soft landing without the Fed helping through lower monetary policy?
No, never.
Yeah, so would it have even happened if they didn't step in? You know, because ultimately what they want is to get the rates perfect. Soft landing, you just wait and then you cut rates slowly. But it sounds like you always need a little bit of help from the Fed there.
Yeah, and then it's also a matter of how tight the Fed is going into that landing. And so what we looked at was nominal GDP versus Fed funds rate. And once you start getting Fed funds rate above nominal GDP, you really have no hope for a soft landing. So you think about like 2018, for instance, we called that a soft landing just so we have, throw it in the bucket and study it. And the Fed paused for 7 months there, but, I think the peak Fed funds rate was 2.5% at that point in time, and nominal GDP was in the fives. So significantly, they never got even close to nominal GDP. Today, you're at a 5.5% funds rate, and nominal GDP is a little over 6. And then you consider the fact they're doing QT on top of that. And so what does that add? The academics at the New York Fed say 50 basis points on top of that. So we're right about, I would say, when you all in the Fed policy, right at nominal GDP. So this is not, again, you've never seen a soft landing. I think our stat was you've never seen a soft landing when the Fed funds rate has been within 80 basis points of nominal GDP. And so we're there. So when I look at it, I don't think we should be expecting a soft landing. I think we should be expecting a hard landing.
So to sum this all up, it sounds like you're more cautious based on all the data than you were in the summertime.
Yes, and I don't know if we talked about this in the summer. We probably did. We view this, as we talked about, through the housing economy. That's our big, I think that's where, in this world of a fiscal impulse, I think that's still where monetary policy shows up first. And so we have seen at this point in time, I think conclusively, residential construction payrolls peak in January of this year, and they've trended lower. The revisions have been lower. The revisions, another thing we're seeing is negative revisions for all payrolls, if we have a great chart, I haven't put it out in the public yet, but I've shown it to clients, showing how these negative revisions to payrolls precede recessions. And usually it's a recession, not a soft landing again. And we're also just seeing weaker underlying stats that precede the housing market. So we just saw multifamily starts fall off a cliff. We have basically some numbers that we watch for clients for when are we hitting a recession, and multifamily starts went to 27,000 last month on a seasonally adjusted basis or a rolling basis. And that's well below our recession forecast, our worst case recession forecast. And I think that's directly attributable to tighter lending conditions that are finally working their way into the system. So yes, we've become incrementally more bearish on the economy since we spoke in June.
So just to refresh my memory, do you still use construction payrolls as you think it's somewhat of a leading indicator?
Yes, we've gone back, and you usually get about an 8 to 10% drawdown in residential construction payrolls before you have a recession. And we're now in a drawdown of residential construction payrolls, but nowhere near that 8% number. I'd caveat that with, again, we're real time, and we're looking at revised data on our historic studies. So the revisions have been pretty negative, even on the residential construction side. And so you have to kind of give yourself a margin of error. And the fact that we've now put in a conclusive peak, to me, tells me that we could be closer to that recession than those headline studies that we look at suggest.
Warren, always a pleasure, man. Thank you so much for all the insights. For those following, watching, here's where you hit it. It's 3Fourteen Research, the number 3Fourteen Research. It's going to be in the liner notes of the podcast, or if you're watching the YouTube, on the YouTube. And follow Warren, man. Always great stuff. Warren Pies, and also 3F_research on Twitter. Warren, thank you, man, as always.
Thank you for having me. I love talking to you guys. and really there've been some private communications we've had. I feel like we're on the same wavelength, and so always a pleasure speaking.
Oh, always, man. You know what we got to do? We got to do tier two REIT with like Buffalo, Cincinnati. Watch
right.
out, that's coming up.
Next
I'll
time,
let you know when we get it off the ground. You can be an anchor investor with us. We'll build it.
That's right. Okay, I'm in.
Warren, thank you so much.
Yeah, Warren, always a
always a
pleasure.
pleasure.
Appreciate it, guys.